Hello and welcome to our Fisher Investments webinar focused on recent market volatility. My name is Josh Einhorn and I'm a Vice President here at Fisher Investments, and I'm joined today by Executive Vice President of Portfolio Management and Investment Policy Committee member Bill Glaser.
Hello, Josh.
Hi, Bill.
Good afternoon, folks. As Josh mentioned, my name's Bill Glaser. I'm happy to be here with you today, particularly in periods of time like now with heightened volatility. I want to talk more specifically about the volatility that we're seeing here and now. And sometimes I'm hearing from investors that today's market environment just feels so much more volatile. And I think sometimes investors, they tend to overestimate current volatility and underestimate historical volatility. But in some ways, the volatility this year has been pretty normal. And in fact, if you think about 2017, the lack of volatility last year was somewhat abnormal. In fact, what you're looking at here on the screen represents the number of trading days, either up or down, where the market moved 1% or more. And what you'd see here in 2017, there was just 8 trading days when the market was either up or down more than 1%. We've already more than doubled that this year. And that's not to say, the lack of volatility last year is predictive in any way. It's certainly not. But I think in some ways, given the lack of volatility last year, it leads folks to believe that this year it's even more volatile than it otherwise will. But pretty much what we're experiencing here today in terms of volatility is pretty normal and pretty normal as it relates to investing in the stock market. Now, of course, the investing environment's never pristine, and I like bringing up this chart because it's a good illustration of that. I understand it's very busy, but it really makes the point well that if you look back at any point in this bull market, there's always been issue after issue after issue for investors to contend with. There's the old saying, if you're waiting for clarity, the market's an expensive place to get it. And the reason for that is because you're never going to have perfect clarity. There's always going to be issues for investors to digest. And going back to the beginning of this bull market, whether it was GM filing for Chapter 11, you had the Detroit bankruptcy, you've had the fears of the so-called pigs, or Portugal, Ireland, Italy, Greece, and Spain. How many Greek bailouts did we have and Greek defaults, to the government shutdown? I mean, issue after issue, whether it's Brexit here more recently, the French and European elections. I mean, this is just very indicative of the investing environment and all these issues that the bull market, that wall of worry that the bull market loves to climb. But as we think about some of the classic correction characteristics, corrections, they're short, they're sharp, they're psychologically driven events, they come out of nowhere, but they also recede just as fast as they come about. And they tend to be based on seemingly plausible news stories. So whether more recently it was based on fears, initially it was based on fears of higher inflation and how that would bring with it higher interest rates. That gave way to really fears of a trade war with China and the tariffs that each nation was talking about placing on one another. To here more recently, you've got increased political risk and political uncertainty in Europe, and in particular in Italy. And as we look at the investing environment today, certainly those are risks, but we think they're low probability events to create a global bear market and to create a global recession. These are plausible, classic correction storylines that investors tend to hang their hats on. And another important point, and I mentioned this in my opening comments, corrections, given how short and sharp they are and how steep they tend to be, we won't try and dance out of the market and try and sidestep them. And the reason for that is because they move so fast. We don't know of anybody who's historically and accurately called a correction, and we won't try and do so either. As uncomfortable and as emotional as corrections can be, the best course of action is just to ride them out. And that might not be the comfortable thing to do, because when you're in that volatility, there's the urge just to do something, to stop the pain, to stop the bleeding. But many times that can undermine one's investment strategy, and the best course of action is to ride them out. And despite that, as you think about some of those fears today, whether it's the higher interest rates, a trade war with China, or political uncertainty in Europe, what we would say is that's all set against a backdrop of very strong fundamentals. I mean, globally, you've got Yield curves are positively sloped, which is conducive to lending and conducive to economic activity. Earnings growth this year is expected to be 20%. And in fact, if you think about earnings growth in this most recent quarter, it was even more than that. Revenue growth this year expected to be 7 to 8%. Capital expenditures are now starting to accelerate really for the first time in many years. When you look at the LEIs, or the leading economic indicators in the US or Europe, those are high and rising, and that tends to be very positive for economies on a forward-looking basis. And then what's more is, we all know we're coming up in an election year. We've got midterm elections here in November, and what we've found is that the stock market is positive 87% of the time in the fourth quarter following the midterm elections. And that positive frequency of returns extends itself into the first quarter of the following year and the second quarter of the following year. It's what we refer to as the 87% miracle. So from a political perspective, our sense is that you're going to have a state of increased political gridlock, which reduces political uncertainty, reduces political risk, and that should be a tailwind for stocks in the U.S. markets moving forward. Now, that's a little bit about corrections. Let's turn our attention to bear markets. And as we think about bear markets, what we've always said is a bull market can end in really one of two ways, or a bear market can develop in one of two ways. You can either get the wall or the wallop. And I'll read to you this quote that Ken had written about in the USA Today. He said, "Bull markets don't die of old age or from maxing out some fantasized preset allotment of new records. They expire when investors run out of worries and reality can't beat lofty expectations, or when some huge unforeseen negative worth trillions of dollars wallops everyone." And that's a very good description, because if you think about the wall, and you've heard the old saying that bull markets love to climb that wall of worry. And if you think about that slide I shared with you, there's never a dull moment. That's very indicative, because as the bull market climbs that wall of worry and digests issue after issue, at some point it gets at or near the peak, and investors become very optimistic and they become very euphoric. And then it becomes very difficult for the market to beat those euphoric expectations. And if the market can't exceed those euphoric and lofty expectations, then it starts to roll over, and that can start the process of a bear market. So that's the wall. If you think about the wall up, as Ken alludes to, it's some big, unforeseen negative that's got the size, magnitude to wipe trillions and trillions of dollars off global economic growth. And as we look out in the environment today, there's lots of risks on the horizon, but we don't think any that have a high probability of having that wallop potential. And here's one way to scale that wallop. I mean, so much of what we do in investing is all about scaling, because if you think about risks in the marketplace, you always want to ask yourself, well, how big is that risk? And does it have the potential to create a wallop? And so the way to scale that is, the global economy in 2017 was about $80 trillion in size. You apply a nominal growth rate to that, and that implies in 2018 we're going to add about $5 trillion to global economic growth. So in order to have a wallop, you need to have a big unforeseen event, or a series of events that cumulatively can wipe $5 trillion off global economic growth. That's enough to get you a global recession, and the markets will react in anticipation of that and discount that ahead of time. That can get you a global bear market. But again, issue after issue that we've analyzed here today, we don't see that as being a high probability. Now, if we were to foresee a bear market, there's a number of rules or disciplines, I like to call them, heuristics, that we've developed over the years that helps us manage assets and deal with the volatility as we go through those bear markets. And so these four disciplines are the 2% rule, the 3-month rule, the 2/3, 1/3 rule, and the 18-month rule. The first starts with the 2% rule. And quite simply what this says is that bear markets, they tend to decline about 2% on average per month. Now you contrast this to a correction. Corrections decline about 7% on average per month. So corrections tend to be a lot steeper. They tend to be a lot sharper. And in fact, if you look at the most recent period, peak to trough, markets fell about 9.4%. That transpired over 8 trading days. That's classic correction activity. as you think about bear markets, they're not that sharp, they're not that steep. They tend to roll over slowly. They die with a whimper, not with a bang. And on average, they fall about 2% per month. Sometimes a little bit more, sometimes a little bit less, but on average 2% per month. Now the 3-month rule kind of speaks to that rolling top nature. What the 3-month rule says is that if you think you've identified the peak of the market, you want to wait at least 3 months before you get out and take a defensive posture. And the reason for that is because you have that slow rolling tops, because they die with a whimper, not with a bang, you're afforded to wait 3 months and you don't get hurt that much. You don't give up that much in losses. And you're allowed to evaluate 3 months of additional incoming data to validate your decision. And you can see here, this is this 1973-74 example, the 73-74 bear market. By waiting 3 months, you gave up about 6%. But the majority of the declines come in the later stages of that bear market when you get about a little bit more than 44% of those declines. So you don't give up that much by waiting those first 3 months. Now that takes us to the 2/3, 1/3 rule. And quite simply what this says is that 2/3 of the bear market decline typically comes in the final third duration of the bear market. And you can see that here. And this really speaks to the capitulation that tends to happen when you get into the final stages of a bear. It's also indicative of the rolling top nature as bear markets tend to unfold. So, but also, as you can see on this chart here, once you've hit that bear market bottom, markets tend to rebound just as violently as they crash. Just as you get that violent capitulation, the rebound off the bottom can be just as significant. And so you want to make sure that you get reinvested and you get re-equitized to make sure you capture the upside that follows. Because following every bear market, there is going to be a bull market, which takes us to the 18-month rule. And really what this says is that you never want to be defensive for more than 18 months. Now, what you're looking at here, this just represents the beginning date of historical bears and the end date of historical bears and how long they've lasted in terms of duration. You can see on average about 18 months, some longer, some shorter. And so this gives you some sort of guidepost of how long you want to be defensive or the maximum amount you want to be defensive. This doesn't mean you need to be a defensive for a full 18 months. You could be defensive for 6, 10, or 12 months, but you don't want to overstay your welcome. Because if you've been defensive for 18 months, chances are you probably already had some decent success in sidestepping the bear market. So you want to make sure you get back in so you capture the upside that follows. Now, as we kind of wrap all that up in the discussion about corrections in bear markets, and we ask ourselves, given what we know about the current market environment, do we think this is more of a correction or a bear? And we believe that all signs point to a correction. We've gone back and we've studied every bear market going back to the 1920s, and we've said to ourselves, what are some of the prevailing features? What are some of the common causes that tend to present themselves as a bear market unfolds? You can see we've listed some of those on the right-hand side. Very few of those are checked off, whereas on the correction side, certainly this correction started off as very short, sharp, and steep. We believe it's been based on overhyped scare stories. The decline, I think it's debatable. We got 9.4%. Maybe markets experience some more weakness and we get into that classic definition of correction territory. But for all intents and purposes, we would think it's characterized as a correction. And then corrections typically recover very, very quickly. We haven't seen that this time. This one's kind of dragged on a little bit longer than we would otherwise expect, which kind of speaks to the slow rolling top that you see, the question mark we have in the bear market column. So maybe there's some debate there from a technical perspective if we've got that slow rolling top. But more fundamentally, if you think about the potential for a wallop, we don't see a high probability of it being out there. Euphoria. Typically at the top of a bull market, you get elevated levels of sentiment. You get euphoric sentiment. We don't see that today. At the top of a market, there tends to be a disproportionate number of low-quality IPOs being brought to the market, resulting in a lot of equity oversupply. We also don't see that here today. And in fact, M&A activity is actually destroying equity at a faster rate than equity is being created. Signs of a recession don't see imminent. We don't see a liquidity freeze. Also regulatory events. So all those things, in our view, add up to this being classic correction market activity and not so much a broader, bigger bear market.
Great. Thanks so much, Bill. And that is all the time that we have for today's webcast. Thank you so much for joining for our webinar on this recent market volatility.